India is consolidating its position as one of the world's largest manufacturing economies. For sponsors and investors, the opportunity is not just the country's growth, it is how that growth is being financed, and whether each transaction is structured to access the capital behind it. In fiscal year 2026, India recorded $58.84 billion in foreign direct investment equity inflows. That was an 18% increase in 1 year. Over the 11 financial years from 2014 to 2025, the country attracted $748.78 billion in total foreign direct investment. The shift of global supply chains toward India is no longer only a forecast. It is a capital reallocation already underway across manufacturing, logistics, industrial corridors, and infrastructure. Three forces are accelerating this opportunity. First, private credit. As banks remain selective, private credit funds are financing mid-cap infrastructure, manufacturing, and industrial expansion. Second, the production-linked incentive scheme. It covers 14 sectors, from electronics and textiles to automobiles and food processing, strengthening India's manufacturing base. Third, infrastructure demand. India's national infrastructure pipeline targeted roughly $1.4 trillion in infrastructure investment through 2025, while capital needs continue across logistics, energy, transport, and digital infrastructure. The capital is coming from multiple directions: sovereign wealth funds from the Gulf, pension funds from North America, development finance institutions from Europe, private credit managers increasing exposure to emerging markets. The common question is no longer whether India is investable. It is how capital can be deployed with the right structure, risk allocation, and local counterparties. The opportunity is not spreading evenly. Activity is visible in Gujarat's industrial corridors, Tamil Nadu's electronics ecosystem, Maharashtra's data center infrastructure, and renewable energy assets across the country. Across these sectors, institutional capital looks for the same profile: contracted revenues, hard currency components where possible, credible local counterparties, and a capital structure that can absorb private credit pricing. Delphos works with sponsors to structure transactions that meet these criteria. That means identifying the right lender type, preparing a bankable information package, and aligning the capital stack before the transaction goes to market. For Indian sponsors accessing global credit or international investors deploying capital into India's infrastructure and manufacturing pipeline, structure determines whether opportunity becomes execution. The capital is moving. The question is whether each transaction is structured to receive it. If you are raising debt for an infrastructure, manufacturing, or industrial project in India, book a structuring consultation at delphos.co.